Hi, good afternoon, everyone. Welcome to this week's weekly market review. We have a special edition of the weekly market review today, where we have a special guest, Issac Lim, who is the Chief Market Strategist at moomoo Singapore, who will be providing us with a market update. At the same time, we have Sunny, who will be sharing with us the technical analysis. Issac and Sunny, how are you today?
Yeah, I'll go first, Sunny, right? I cut your cue. But yeah, I'm good. Excited to come back from a short break. I think it's going to be quite an exciting time in the markets, especially for 2025. And yeah, all in I'm just really happy for to be invited by you guys over here to share my views with the audience.
Thank
Yes, I
you
like
for
to.
joining us today.
Yes,
Thank you.
thank you, Isaac, for joining us today. I think we love to have you here more often to share with us your views on the market. I have also read your outlook on the global markets on your moomoo platform as well. I find that insightful, and I believe you will share some of that with us today.
Yes, that's right. Thanks so much for your support always, Sunny. Right. Yeah, but I think it's always nice to share, views and also to hear. I look forward to your sharing on the technical analysis aspect as well. What to look out for. It's always very interesting for me to open my eyes, open my mind to see what people are also looking at in the market.
Okay, so maybe without further ado, we'll get Issac to share with us his market outlook before we go into the technical analysis later. So, Issac, over to you.
Hey, thanks, Gerald. Just share my screen. Okay. Right. So hi everyone. Good morning, and yeah. But really glad to be here with the SIAS team as always. Right. And just very quickly, I want to share with you guys what I'm expecting to look out for, at least for the first half of 2025. Now, generally, I don't like to give the whole year outlook. Because as you guys know, there are a lot of analysts outlooks from the banks, and they tend to give a whole year outlook. Most of them tend to miss the targets, sometimes by a mile, sometimes completely the other opposite direction, right? But let's keep it a bit more short term, right? More near term. So for the first half 2025, this is what I have, the playbook to stay ahead for the year. So very quickly, I will just give a backdrop to where we are in January, right? We're coming to the end. We're already 3 weeks into January, but so many things have happened. And I think, now that we're 3 weeks into January, I feel like next week we're going to enter into 2026 already. And then I'll share very quickly the major themes that I see for the first half of 2025, moving into what are the main trading ideas, right? I'm not going to put the live analysis part. I think that one I'll leave to my friend Sunny, right? But other than that, okay, just want to disclaim over here that these views are really more macro, more big picture approach, right? So it's not telling you guys exactly what stocks to buy, or which where's the entry level and all that. It's really just telling you guys, the listeners, right, our audience, how to position your portfolio, or rather, how I would position my portfolio for at least the first half of 2025, given the themes that I see in the market. So very quickly, this slide was updated just last week, but still very relevant. This is the story so far because we're only 3 weeks into January, right? Chinese stocks have fallen by about 6%, but it has already rebounded by a bit. With Xi Jinping and his team, looking to inject more stimulus. And as mentioned before, right, the government, the Chinese government, right, was very committed to meeting their 5% GDP growth, and they actually met it. In fact, they met it at 5.4%. And then over in the Western world, we have Canada's PM Justin Trudeau. He stepped down, citing that there was too much infighting in his party, right? Finally giving way to the democratic process, saying they should elect a new leader. And then, of course, we have this whole credit interest rate inflation issue across the world. You have US 10-year yields back to 2007 highs, just shy of 5%, which is pretty crazy considering the fact that, the narrative in Q4 last year was that the Federal Reserve is going to start cutting rates over the course of 2025 as well, right? Over in the Chinese markets, we see that the 30-year low yield is now below Japan's 30-year yield. Very, very interesting. Also because, China is facing some deflationary pressure, which some observers have likened it to Japanification. And then, of course, there's the US LA deadly fire. Eurozone continues to struggle, with Germany recording the highest company insolvency since the GFC back in 2008. And then, of course, we have the US dollar, which really strengthened a lot, coming close to the 2021 highs, I believe, and it reached its highest since 2023. Then, of course, you have Donald Trump. Before coming into office, he started his rhetoric by talking about taking over Greenland, Canada, Panama Canal, renaming the Straits of Mexico to the Gulf of Mexico to the Gulf of America. And, more recently, I was just having a very fun discussion with Sunny and Gerald. If you guys have been following the news over the weekend, Donald Trump launched his coin, his cryptocurrency, which was really crazy, because when he launched it, I read on the forums, not sure how true, take it with a pinch of salt, but basically some guy he bought like 1.3 million of Trump coin, and then over the weekend, the growth of the coin went up by 2.5K%, right? And what was interesting is that, last night I saw it, right? The coin actually went up to 13,000%, right? So things are really crazy, right? There's so many things happening in the markets, right? So what can investors expect? So moving ahead, these are some of the three main themes that I really expect, that I think investors and even active traders should look out for the rest of, at least for the first half of 2025, right? So the first theme, I'm cheating a bit, I'm combining three into one, right, is the three T's. So investors, we really have to look out for Trump, right? The policies, the tariffs that he brings, and the possible trade wars in retaliation of his tariffs, right? So inauguration is, I believe, is tomorrow, right? Interestingly, from the very protectionist kind of image that Trump was presenting his first round of presidency, and even in the lead up during the presidential race, Trump has sort of moved towards the expansionist agenda, right? He's starting to push he's starting to push to look global, right? In the sense that he announced over the weekend, okay, cryptocurrency, right, digital assets is going to be one of the key focus of his administration. And then he made a very strong announcement that he actually had a phone call with President Xi over in China, and they are looking to build a new era of world peace, right? So it's very different from the tone that he had in the first round of presidency, and then leading in the entire presidential race, right? So the tone has sort of pivoted a bit, all right? So really, Trump is this wild card that I think all investors should pay attention to what he does, but not what he say, right? So I think action really speaks louder than words at this point in time. And of course, if his tariffs follow through, it really could risk triggering a not a chain reaction, but chain retaliation from all his from all of US trade partners, right? Trade war 2.0 with China could very well happen, and possibly, as mentioned, with other trading partners as well. All right, so that's the first broad theme: Trump, tariffs, and trade wars. And then, of course, the second theme that I think investors would like to hear, right, is that, we hear a lot about US exceptionalism, seeing how the US market has grown in 2023, going into 2024, right? So for me, the US still remains the favorite market, right? It is my market darling, right? But, the growth may be a bit more measured at this point in time. So investors should temper expectations. Mega caps, I've said it during my moomoo presentation, I'll say it again. Mega caps are now more expensive than before. Previously, the traditional way of understanding the US market was large cap, mid cap, small cap, right? And the S&P was broken into large cap and mid caps. And then the small caps was really the Russell 2000s. But over the course of 2024, we now have this new term called mega caps, which really refers to the top, the big seven, right? And or the Big 10, if you want to extend it a bit further, right? But really the mega cap, right? The big seven counters in the S&P, and then followed by the large caps, the first half of the rest of the S&P, and then the mid caps, the bottom half of the S&P, right? So if you look at the Max 7, the Max 7 are really now a lot more expensive than before, right? So I think investors should not really just keep focusing on the Max 7, right? But learn to look elsewhere, right, within the US market, and also try to look for a bit more undervalued opportunities in other geographical regions as well. And then, of course, US, one of the biggest challenge that Donald Trump will face stepping into office tomorrow is that US has actually about 7 trillion USD debt outstanding to be paid, right? If you guys remember back in 2023, this was the issue that actually caused a meltdown in the 2023 markets when they failed to extend the debt ceiling, and then there was an emergency raise of the debt ceiling. And finally, the third broad theme is that, the US dollar, I think the US dollar will reign supreme against persistent inflation that we're seeing across the globe, right? Given the CPI numbers, Sunny asked me just before this webinar, given the recent CPI numbers, has my view changed? I think it hasn't, because really this is more for the first half. And at the same time, we still have to see quite a bit of data. And like I told Sunny, Trump remains this wild card that we're not really sure about, right? But all in, US dollar is king. The US labor market still remains pretty robust, right? Global bond market's a bit shaky in terms of pricing, right? But we really have to see how it's really a dance between Donald Trump and Jerome Powell, right? How Trump's policies may or may not bring inflation. I mean, everybody's expecting inflationary policies, right? But may or may not bring, okay? And how Jerome Powell and his team will actually struggle to contain the inflation, right? So we started the year with about 3 rate cuts for 2025 from the Federal Reserve, but now the expectations has gone down to 1 rate cut, but in June or July, right? So, markets are evolving very quickly, right? But that is to be expected. Okay, so these are the 3 broad themes. I will move quickly into some of the key plays that I think investors should look out for. I don't want to take up too much time, but let me just show you guys the 3 key plays. Okay, so the 3 key plays that investors should really look out for. The first thing, okay, is really to stay adaptable, looking to US large and mid caps, right? So you see here, I didn't say mega caps. I broke it down to large and mid caps, right? So near-term consolidation expected. I think this one, we are already looking at it, okay? I do think there still might be a bit more consolidation, at least for the next 1 to 2 weeks. And then the market will decide whether we are going to go higher, right? Or go lower. Of course, my preference, my bias for it is definitely to go higher. So I mentioned earlier, mega caps are quite expensive and stretched in terms of valuation if you look at their PE ratios, right? But large and mid caps have yet to fully catch up. So at this point, I just want to quickly show you guys a PE last 12 months, trailing last 12 month chart, right? So you can see that the small caps, the PE is around 150%. S&P, taking into account the mega caps, right, is about 29.3%, right? About 30%. Okay, but then of course you have the mid caps, which is at around 23.6. So from a valuation perspective, from PE ratio perspective, right, the mid caps is definitely still pretty much tempered. There still lies quite a bit of nice opportunities over there. Okay, so that is the second point. The third point, while US remains my market darling, right, undervalued options can also be found in other geographical regions, right? So don't be afraid to look elsewhere, okay? And last thing that you really want is to have your portfolio really concentrated within the US markets alone. Okay, the second key play for investors is really, as I mentioned, one of the themes is that US dollar will still stay very strong, right? But, given inflationary expectations, inflationary pressures around the globe, I believe that we have to put that cash to work, all right? US dollar may be king, but with inflation, the value is going to be eroded over time. So what I will suggest for investors and active traders is to take advantage of the early higher rate environment to lock in yields. So I'm not saying lock in long-term yields, right? But maybe you start locking in the shorter term, like maybe 2 to 3 years, or for those of you who are a bit more risk-loving, right, you can lock in the 3-month, 5 months T bills, and then you roll it over, right, taking advantage of the higher rate yields at this point in time. But of course, that is I have to disclaim here that this is not taking into consideration your transaction cost, your FX currency risk, and all that. All right, so you need to do your own due diligence, your own calculations, but this is how I see for the way forward when it comes to handling US dollar. So of course, US Treasuries, as I just mentioned, and investment grade bonds remain the preferred conduit for me to use in this first half of the year. Moving on to the third point, and I think looking closer to home, right, is that, don't blindly just chase alpha, right? So alpha is the risk-adjusted returns, the returns that you can get from the market, right? Discounting risk, right? But consider building a dividend portfolio within your overall portfolio. The reason is because, dividend portfolio, as I'm sure you guys will know, will help to provide some consistent cash flow during this global inflationary pressure, right? I just want to show you guys, I'm just going to move very quickly to this chart, right? This is a yield curve chart, okay? I really like this chart. I think it's very important to look at, right? But it is not the be all and all. But very quickly, right, the bar chart here, the candlestick chart is the US yield curve. It's against the S&P, which is in orange. Just a bit of history, if you look back to the dot-com bubble burst, you can see that when the yield curve inverted and steepened back above zero, right? So it's called a bear steepening, right? So it steepened above, and 3 to 4 months in, right, we start to see the S&P sell off, right? There's a huge meltdown followed by a recessionary period, right, in the S&P. Same for the financial crisis. We flirted around the 0%, inverted, and then steepened. 3 to 4 months in, there was the major financial crisis, the S&P sold off. Right now, where we are at, okay, we have inverted and now we have steepened, right? We are already 1 month in, right? So maybe in another 2 to 3 months, right, we may see a bit of a meltdown in the S&P, right? That's according to the yield curve and compare it to the S&P index. So when there's a meltdown in the market, clearly stock prices are going to fall. Our capital gains clearly are going to drop. But what will keep us going at this point in time will be the consistent cash flow from the treasuries, from the dividend portfolio that we are building. So, again, I had a lot of conversation with Sunny before this webinar. And, he asked, what sector then do I want to talk about within the Singapore markets? I told him, I don't really want to talk about sector because my answer will be the same, right? Unfortunately, for those of you who are investing in REITs, it's been a very painful journey. Capital gains not there, but if you look at your dividend yield, right, I'm sure you guys have been consistently generating some sort of nice dividend returns over the past few years. And that brings me to my second point, which is that Singapore's low volatility market, coupled with strong governance currently and currency, the Sing dollar, MAS is committed to defending our Sing dollar because really it is sort of the natural resource that we take charge of, right? This makes the Singapore market the preferred market to build a dividend portfolio, right? So very quickly, I'm just going to show you guys just some of the stocks that I've highlighted, Singapore stocks. You can tell it's really a mix. It's not just banks, right? But you also have the engineering, the industrials. You have the defensive sector like Singtel, and then of course you have quite a number of REIT counters. But you can see that the dividend yield, right, for this Singapore stocks, right, our major Singapore stocks on the STI, the dividend yield is really pretty much high, given its performance. Right, so all things considered, just want to move back a slide. Okay, is that don't blindly chase alpha. Seeing that there are some headwinds in the markets, possible market meltdown according to the yield curve, and not knowing really what Trump's new policies will bring. Okay, I think it's important to be a bit more defensive, right? And build this dividend portfolio as well. And anyway, it's never too late to build a dividend portfolio. I'm sure my friend Gerald and Sunny will both agree, right? The best time to plant a tree was yesterday. The next best time is today. All right, so again, just a quick recap. 3 broad themes. Okay, for the first half of 2025, we watch out for the 3 T's: Trump, tariffs, his policies, essentially, and trade wars that it might bring. US still remains the favored equity market, right? But let's manage our expectations a bit, learn to look around large and mid caps and even possible other geographical regions. And with US dollar reigning supreme against inflationary pressures around the globe, right? Learn to put your US dollar, your US cash to work into US treasuries or even investment grade bonds. And to round it all up, these are the 3 key plays that you, my friends, as investors and active traders, can look out for, at least for the first half of 2025. So, with that, I'm going to just end my short sharing on the first half of 2025, what I expect to see. And we can keep the questions to later. But over back to you, Gerald. Thanks so much for your time.
Thanks so much, Isaac, for the insights. We'll definitely go back to you with some questions later. But before we do that, we have got Sunny who will share with us the technical analysis.
Okay, thanks, Gerald. Thanks, Isaac. Let me share my screen first. Okay, but firstly, I want to thank Isaac for that very detailed presentation, although just a few slides, but then full of content, full of perspective from different angles. Some of the viewpoints I largely agree. Singapore banks definitely is a no-brainer. Definitely, if you are looking at like what I told my parents, if you are looking at putting into a fixed deposit in one of the local banks, why not consider putting some of it in the Singapore banks, which are having dividend yield of close to 5%. Okay, so that could be something that we should look at if you are looking to build a dividend portfolio. Okay, and on the US side, yes, large cap Max 7 is the valuation is very high right now, but my views are biased. I am still banging on the big tech stocks that it will go higher this year, continuing the AI revolution. But I have, even though the growth might not be as lucrative as the previous few years, I usually execute those position using the leverage ETF on the mega tech stocks, which some of the mid caps and the small cap may not have. So probably that could buffer a bit and catch up and generate the returns that the smaller caps will provide as well. Okay, so I think just now when I started sharing my screen, you see Palantir stocks on my screen as well. So I was looking at it, the performance for the past 1 year in 2024. So Nvidia was the darling indeed, but Palantir stock actually rose like 300% last year, beating Nvidia to become the best performing stocks in the US. So that is in line with what Isaac has said earlier. Some of the mid cap and the smaller cap may outperform the larger cap, and that's one example that you see over there in the stock of Palantir. Okay, so I would round off the updates for this week, starting with the STI index. So last week, or probably somewhere on the 8th of January, the beginning of the year, we saw the STI touch a new 17-year high. The target now that we are looking at is 3,887 points over here. After we touch that, we have a bit of a pullback, partly due to the strong US non-farm payroll data and the fears that we might see rate hikes again this year, which is a good thing for the banks, but may not be a good thing for the REITs. So the general market has some worries, and we have a pullback towards the 20 days moving average, which is the Bollinger Band basis, as you can see here. So up to today, we are still holding on to that 20 days moving average at around the 3,700 and 96 points level, or we round it off to the 3,800 level. This will be the pivot level to look out for on the STI index in the short term. Okay, the next support could likely come in around the blue line that you see here, which is the exponential moving average 50 days, now at around the 3,757 points, so 3,750, 50 points below the 20 days pivot. 3,750 will be the next support level on the STI. Of course, we also have the lower bound of the Bollinger Band at 3,724. Okay, so STI is likely. You can see that I have drawn a price channel on the STI, sort of starting somewhere in the second half of 2024. So this price channel is largely intact, but recently at least in the last few trading sessions, we see that the index point on the STI starts to break below this level. So there's some kind of a weakness here. If this break down towards the 50-day exponential moving average or even the lower bound of the Bollinger Band, then probably STI could be moving into a range-bound sideways trading direction and waiting for a new catalyst or some market movement that the markets might be looking out for, which is the first one, of course, is one of the triple T that Isaac mentioned, Donald Trump taking office this week. And then what are the things that he will enact? I've heard that he's going to sign like 100 executive orders the first day he get into office. And of course, what are his plans on the trade war, or if there's going to be any trade war or tariff war going forward. And then the week after, we have the Chinese New Year week, which is a shortened trading week on the SCI. So likely not much of a movement. But then once we come back from the Chinese New Year holiday, we will see some of the Singapore local banks announcing their earnings. So that could be the next catalyst for the STI to retest the 17-year high again that we saw earlier this month at 3,887 points. Okay, so if you are looking at the STI or the STI ETF to accumulate, you can look at the 50 days moving average 3750. That is that number over here. That will give you a buffer from the pivot point of 3,800. And of course, you can accumulate more on the lower bound of the Bollinger Band at 3724. Okay, looking at the indicators wise, STI, the MACD indicator is still negative. The trajectory is still downwards. So definitely a bit of a downwards pressure there, according to the MACD indicator. The RSI is a pretty neutral at 51 points, very close to the 50-point neutral mark. So not much of a momentum kind of reading on the STI for now. Likely it will be range bound until Chinese New Year, until we see a new catalyst in the form of Trump policies or even the bank earnings that will come up in early February. Okay. Next, let's move back to the US markets. So you can see the Dow Jones Index, we pulled back from the all-time high in December, and now we are at 43,487 points. It is testing the upper bound of that Bollinger Band. Prices usually trade 90% of the time inside that Bollinger Band, and we have tested that level, 43,535 points last Friday. So even with that signal, you can see that, of course, I don't think I need to draw a price channel on the US indices. It has been on a mega uptrend for last year and in 2023 as well, over 20% gain over the longer 2-year term period. So that long-term trend is likely going to be still in play this year. Recapping what Isaac said earlier, he only likes to forecast to the half year of 2025. And what the other major banks have forecasted is like maybe we will see most of the major indices in US, especially the S&P 500, having a sort of a low double-digit gain this year only, not the 20% that we saw last year, but probably close to the 10% level. That will bring the S&P 500 to the 6,500, 6,600 year-end target. Okay, so that number, of course, is hit and miss. But looking at the Dow Jones Index right now, the MACD indicator is very positive and showing strong momentum. We have a crossover happening last week of the MACD above the signal line that could signal the start of a new uptrend when the Dow Jones Index was closer to the lower bound of the Bollinger Band at 41,940 points. So 42,000 is the near-term support that we are seeing. And then if let's say you pull back towards the 42,000 or even the 20 days moving average at 42,700 level, that could be the level to accumulate on the Dow Jones Index. Okay, RSI is looking pretty healthy. We have crossed above the 50-point neutral mark, now reading at a 56-point level. So if it cross above the 60-point level on the RSI, momentum could build up quite quickly as well, and we could really retest the 45,000 level, which is the all-time high of the Dow Jones Index. Okay, next, let's move to the broad index on the S&P 500. So S&P 500, similar movement in like what the Dow Jones is moving, but then we can see that it is strongly supported over here in the later part of December as well as early part of January. This level here at the 5,830 points level, we had a bounce twice, and then we have a breakdown towards the amber line here, which is the 100-day exponential moving average. This was due to the worries because we have a very strong non-farm payroll data, and then we saw a pullback because there might be interest hike again, or maybe interest will stay elevated and we have lesser interest rate cuts. But then after that, we have a good rebound on the S&P 500. So market is not really worried on that front because last week we saw the start of the US earnings season, and we have seen that the big banks, that US big banks, have started reporting their results, which is a very strong result, I would say, for the US banks. So market actually rebounded. That caused the Dow Jones and the S&P 500 to really sort of outperform. Okay, so where's the resistance now? The resistance, I think the near term, of course, will be upper bound Bollinger Band, the 6,000 handle. We are just 4 points away from that. That is the psychological level. And just slightly above that, another 50 points above the 6,000 level, you will see the upper bound of the Bollinger Band at 6,046 points. So if we look at the all-time high, okay, it will be here, the 6,099 points or 6,100 points. That is the target that we are looking at in the short term to retest this level. And when we get there, we will reassess again what is the situation like. Okay, on the indicators, S&P 500, we have a crossover confirmation from the MACD indicator. You can see MACD line crossover signal line last Friday, and then we have a positive MACD reading. So that could be, this is a signal that we could see a new uptrend from here. Okay, the RSI is also gaining momentum from last week, close to below the 50-point reading. We are now seeing a reading as of last Friday at 55 points. So momentum is catching up or starting to build up, I would say. And once it reached the 60 point, we could see an accelerated jump in the S&P 500 index according to the RSI indicator. Okay. Lastly, let's go to the tech-heavy Nasdaq Composite Index before we ask Isaac some of our questions on our minds. So Nasdaq, okay, has been trending around the 20 days moving average around the 19,509 points. Last Friday closing 19,630 points. So it is close to the pivot level, but could be supported by the blue line that you see here, which is the 50 days exponential moving average. The last time we see it tested this level was around the early November period, and then we have seen the rally carry on. So this level, the 50 days exponential moving average, the blue line here at 19,290 or 19,300 points, will be the support level, first level of support for the Nasdaq Composite Index, followed by the lower bound of the Bollinger Band at 18,966 points. So the 19,000 handle will be next if we break the 19,300 level. The amber line, which is the 100-day exponential moving average, now at 18,800, will likely catch up to find confluence with the low bound of the Bollinger Band. So if really we test the 19,000 handle, that will be a very strong level or very strong support that the Nasdaq Composite Index will be relying on to see a rebound to retest the previous all-time high that we saw in December at 20,204 points. Indicator-wise, we still don't have a confirmation yet, but like all technical analysts says, technical indicators are always lagging. So if you foresee that, you can see the trajectory of the MACD line and the signal line. A crossover is likely going to happen this week, and in that happens, then the index will have a start of a new uptrend according to the MACD indicator. And the RSI reading at 53, 3 points above the 50-point neutral mark. You can argue that it's still weak right now, closer to the 50-point neutral mark. But once it starts to trend higher, then definitely momentum will be building up. So although there were some arguments among TA that indicators are always lagging, but if you see this kind of formation forming among the indicators, you could try and sort of foresee what is going to happen this week. And if you think that the crossover of the MACD is going to happen, that means we may see a MACD positive reading this week and RSI probably challenging the 60-point level, then definitely the indicators will be showing a positive reading going into this week, and you can sort of preempt what is the market movement likely going to be. Okay, going into the second half of January. Okay, so these are the updates that I have for you this week on the indices. Let's move to the Q&A.
Okay, thanks so much, Sunny, for the sharing. I think we have a very complete view of the markets from what Isaac shared earlier, as well as from the technical analysis that you shared with us. So I'll jump straight into questions. I think Isaac has brought us through some of his views on the market, and US is definitely one key market to be looking at. Isaac, earlier you shared around your views around mega caps versus mid and large cap stocks in the US. A lot of investors are also interested in thematics such as AI, quantum computing. How do you think investors should be positioned then based on thematics?
You guys can hear me, right?
Yes.
Great question, Gerald. I think before I dive into that, just last week I was at a industry lunch, and very interesting. They actually invited, I think, the number four guy in NVIDIA, this guy, Dr. Simon C, to come down and talk. And what I really took away from that was that, going forward, even the software, the computer scientists, the software engineers at NVIDIA, what Dr. Simon C said back then was that even they do not know where where the AI technology might go next. Because really, this whole AI thing really just started out as more of a predictive technology. They were just trying to predict the next word. They're trying to predict the next sentence. But that has sort of evolved into, the whole large language model, generative AI that we're seeing today, ChatGPT, Claude, and all, and Sonnet, all that kind of thing. So, I think with this whole thematic, back to your question, Gerald, with this whole thematic thing, of course, I do see certain themes like, the inflationary risk. So we want to move into a more defensive sector, right? Such as maybe communications or healthcare. But at the same time, taking this whole AI into consideration, like what Sunny shared during his TA sharing, the whole AI story has really just shifted the entire market in one direction, right? So with AI coming into the picture, my question is thematic, I'm sorry, but I'm going to answer your question with another question, which will be, is thematic really going to be very important? Or how important is thematic going to be if now the traditional understanding of sectors and thematics is being challenged, right? Healthcare used to be a defensive sector, but now with healthcare going forward in the future, starts to, integrate all this AI technology. They are saying that, we can even start using AI to start predicting whether this patient is going to get cancer or this patient is going to get a terminal illness. What are the immediate treatments, right? Things like that, is really going to change the entire healthcare sector, right? So is healthcare going to be defensive in the event that, AI technology falls short, right? So that's the question that I constantly ask myself. And that's also what I think I will ask back to our listeners, our audience as well. But really, to give your answer, to give a proper answer to your question, I think thematic technology, like what Sunny pointed out, is going to be very important, right? There is no way that we are going to avoid it. In fact, technology is only going to grow exponentially. It's going to it's going to seep into every single aspect of life. So I think the thematic of technology, AI, will be something that investors should focus on, but not just the main idea, right? So like I said, we have to look elsewhere. Okay, so practice a bit of second order thinking. We can look at cybersecurity, right, which is really important in this day and age of IT and AI, right? And in fact, not just cybersecurity, but maybe we can look into let's say something like I just want to say HR, right? Those HR or data processing companies, right? That start pulling together all these huge chunk of data to generate some sort of HR human resource arrangement for major companies out there, right? So these are just some of the things that I've been toying around in terms of thematics, some of the opportunities that I share with people where the market can possibly head into at least in the next few months ahead. So sorry if that was a bit lengthy answering your question with another question, but I hope that answer was good enough.
Definitely. I think you give us some ideas to actually look at, which is what a lot of our audience today will probably be looking up more into. The next question is around your outlook around some of the undervalued options in other geographical markets. I think one market that we did not touch on so far is China. And the question that many participants will have is it actually time to bottom fish in the Chinese market?
This is a very good question. It always comes up, but also a very tricky question, right? I like to say, right? Believe in the Chinese government, because you can tell that if you look at 2024, the performance of the Chinese market, it was exciting at the start when we saw a technical recovery in the Chinese market, and then it was pretty dead for the majority of the year. And then towards the end, just before the Chinese Golden Week, right, the Chinese central government injected, as we all know, a huge stimulus bazooka into the market. And then because of that one announcement, that one day, right, the Chinese market actually shot and overtook all the other Asian markets and became the best performing Asian market for that month, right? I believe it was October. So the way I look at it is, the Chinese government, right, they at that time they said, at the time I believe their GDP was only 4.1 or 4.2%, with only 2 more months to go, right? Because we're already halfway into October. They came back from the Golden Week, right? And the Chinese government said, we will make sure that the GDP meet our target growth. And Xi Jinping said, we will meet our target growth. And it's very interesting because in a recent announcement, they did meet their target growth. And in fact, their target growth was more than 5% that they set out at the start of 2024. It was 5.4%, 5.2%, right? But so what I want to say is, where the Chinese markets are going, I think keep a lookout, right? I do think that the companies are actually undervalued. All right, I do believe the companies are undervalued. But the issue is really everybody is waiting on 2 things. Firstly, what Donald Trump is going to do. Secondly, what is the Chinese government going to do? Right? So it is at this point that I will refer to the living legend Warren Buffett, right? Is that, when you want to invest, okay, don't take 2 feet into the water, right? Take one step in first, right? Test the depth, okay, and then you slowly invest, right? If valuations are cheap, right, then it's okay to buy a bit. If valuations get cheaper, right, then you may want to buy just a little bit more, right? You don't go all in, right? For our listeners, don't go all in, okay? Because when the tide goes out, that's when we find out who's been swimming naked, right? So I think when it comes to the Chinese market, okay, it's always good to have a bit of exposure, right? But don't overexpose. Don't try to time the market, right? I just want to end with this example, very recent example when it comes to the Chinese market. If you guys remember in the news, at the start of 2024, there was a well-known local hedge fund, right, that has been operating in Singapore for many, many years, right? Even the founder of the hedge fund had more than 3 decades, right? That's nearly how old I am, right? More than 3 decades of investment experience in the markets under his belt. He had institutional experience, he had retail experience, he even had government experience, right? But he was investing into the Chinese market, and then he was shorting the Japanese market because of his views on macro and all that kind of thing. But unfortunately, by the first quarter of 2024, he actually had to shut down his fund because he was bleeding money like crazy, right? And that's the thing. He was not wrong in his view, because if you look at what happened in August, the Japanese market actually sold off because of the yen carry trade, right? August last year. And then in October, the stimulus bazooka shot the Chinese market up. So his view was not wrong, but his timing was way, way, way off. So I think the advice that I have for our audience, even is a good reminder for myself, is that, don't always try to time the market. You have a view, right? Stick to it, right? But test water a bit in bite-sized pieces so that it makes it a bit more long-lasting, right? As investors, as traders, we want to be able to play the long game. It's not about the big profits at one go. Yeah, so I hope that answers your question with regards to the Chinese markets.
Yes, and also a few tips that can be helpful to our viewers today. Lastly, moving something that is very close to home, which is the Singapore market. I think you shared some of your views around the Singapore market, particularly from a dividend angle earlier. So recently we saw the STI reaching an all-time high. And I think the question at the back of many investors' mind is whether there's going to be more upside ahead. So what are your thoughts on the Singapore market?
Thanks for the question, Gerald. So in short, right, I do have directional bias for the STI, and my directional bias is definitely bullish for the STI. I must say that the performance of the STI in 2024 really surprised me. So I was very pleased to see that, the STI actually shaped a very nice bullish breakout above its 2018 highs. So we might see a bit of near-term headwinds, right? Given that Trump is taking office and Singapore is in this very sensitive spot where we have to learn to balance the relationship between China and US well enough, right? Not leaning towards either side and really protecting our own sovereignty at the same time, right? So it is I do see STI breaking higher, right? But some of the headwinds, as I mentioned, are really the geopolitics, and of course, this year we also have our own local politics to look out for. But one thing to note is that I've done the correlation studies. Generally speaking, while there's short-term volatility in the STI around the time of local elections, around the time of our local general elections, at the end of the day, the market will still do what the market wants to do, right? So let's have a bit more of a forward-looking, longer-term view on the STI and not be too shaken by the near-term volatility when the general elections does come around.
Thank you so much, Isaac, and thank you, Sunny, for joining us today.
Thanks, everyone.
Thank
Thank
you.
you.